Good afternoon. My name is John Mountain. I am the Director of the Investment Funds and Structured Products Branch at the Ontario Securities Commission. Welcome to the Registrant Outreach session that is being held today on April 11th, 2017 to discuss the CSA's consultation paper 81408, a consultation on the option of discontinuing embedded commissions in the sale of mutual funds and other investment funds. With me today are two members of my team who are the principal draftspeople from the Ontario Securities Commission's side of the paper 81408, Chantal Mainville and Andrew Papini. I'm going to turn it over to them shortly to lead the conversation this afternoon, but I wanted to ask that people send any questions they have through the course of today's presentation. Those questions will be collected, and we will be having some time towards the end of the discussion to address the questions. You should see on your screens a question box. Just type your questions into those and send them to us, and we will collect them and address them. So without further ado, I'm turning it over to Chantal to begin this afternoon's discussion.
So our goal for today's presentation is to first give you some background on the CSA Mutual Fund Fees Review project, and in essence give you a brief overview of how we got to where we are today. And second, I'll highlight for you our consultation objectives under CSA Consultation Paper 81408. Andrew and I will then give you an overview of the matters discussed in that paper, and then we'll end our presentation with a discussion of next steps. We expect our presentation may take 30 minutes or so, after which we'll be happy to respond to your questions. As most of you know, we've been consulting on the issue of embedded compensation for a number of years. Our examination of fund fees, including fund-embedded commissions, began with the CSA's publication of CSA Discussion Paper 81407 that was published for comment in December 2012. And it was there that we first examined the conflicts of interest that mutual fund-embedded commissions give rise to for both the manufacturer of the fund product, that being the investment fund manager, and the distributor of the fund product, that being the dealers and their representatives. I want to stress that our fund fees review is focused just as much, if not more, on investment fund managers as it is on dealer firms and their representatives. Specifically, our concern isn't solely about how the current embedded compensation model can potentially bias advisor recommendations. Our concern is also about how that model can potentially influence fund manufacturing as well as performance in a way that may be detrimental to investor outcomes and market efficiency. We think it's important for us to examine the conflict that embedded commissions raise for the investment fund manager in light of its duties as a fiduciary under securities legislation. In our initial consultation paper, 81407, we solicited comments on a range of regulatory options that we considered could potentially address the concerns that we identified at both the dealer and investment fund manager levels. And this included, among other options, the implementation of additional standards or obligations for dealers and their representatives, a proposal that's being considered separately under Consultation Paper 33404, which is perhaps better known as the Best Interest Initiative, and the option of discontinuing the payment of embedded commissions by investment fund managers to dealers. So while there is a bit of overlap between our work under 81408 and the work being done under 33404, in that both examine dealer compensation conflicts, there's no such overlap with respect to our examination in 81408 of the investment fund manager's conflict, and that's a large part of our focus here. We followed up our written consultation under 81407 with in-person consultations in the summer and fall of 2013. And this included a roundtable here at the OSC in June 2013, and other jurisdictions, including Quebec and BC, also held local consultations in the summer and fall of that year. So we gathered all the comments received through the written and in-person consultation processes, and one of the key comments that we received from industry was that it's not enough to proceed with any regulatory reform on the basis of a perceived conflict. We were asked to provide evidence of harm to investors from these conflicts. Specifically, we were asked to determine if the misalignment of interests materially impacts investor outcomes and whether the alternatives to commission improve outcomes. So we undertook some research. In 2014, we issued an RFP for 2 pieces of research. We retained the Bronsbury Group to examine whether the nature of advice and investor outcomes vary depending on whether advisors are compensated under a commission model or a fee-based model. That research consisted of a literature review based on existing relevant research and was published in June 2015. We also retained Professor Douglas Cumming to examine whether the payment of embedded commissions influences fund flows. That research was an econometric study based on fund flow data spanning a period of 11 years, which was obtained directly from Canadian investment fund managers. Overall, the research showed that embedded commissions are sufficiently problematic to warrant regulatory action. Specifically, the Professor Cumming research showed that embedded commissions considerably reduce the sensitivity of fund flows to past performance. The greater the payment, the greater the level of net flows that is indifferent to past portfolio manager skill, or alpha. Stated more simply, the more trailing commission an investment fund manager pays, the less their performance matters in the sale of their funds. The Bronsbury Group research had a number of findings, including that funds that pay commission underperform, mutual fund distribution costs raise expenses and lower investment returns, higher embedded commissions drive mutual fund sales, embedded commissions bias advisor recommendations toward higher commission-generating products. The Bronsbury research, however, cautioned that there is no empirical evidence at this time to support the view that investor outcomes would be improved under fee-based compensation relative to an embedded compensation model. It reminds that fee-based compensation is not a behaviorally neutral form of compensation. It can still be misused to the potential detriment of investors. It further reminds that there are other forms of incentives, such as bonuses and contests or the potential for promotion, that can incent an advisor to recommend one product over another, and that we need to address these incentives concurrently with any regulatory action we may want to take to address incentives from embedded compensation. Based on the research, we conclude that embedded commissions encourage the suboptimal behavior of both the investment fund manager and the dealer and their representatives. The embedded commission model appears to be designed to mutually benefit investment fund managers and dealers and their representatives to the potential detriment of investor interests. It promotes self-serving behavior and thus distorts the allocation of capital and impairs investor outcomes. More specifically, underperforming investment fund managers are attracting more assets than they should, and investors invested in their funds are not getting the returns they should otherwise be getting. This makes for inefficient capital markets. In our view, the evidence strongly suggests a need to consider change. Despite this, the industry maintains that to do away with embedded commissions would lead to an advice gap, particularly for smaller investors who may not have the means to pay for advice up front, and that this would impair their ability to save and consequently their readiness for retirement down the road. The evidence the industry has consistently pointed to in support of their position has included the Serrano Value of Advice report. This econometric study finds that investors who use advisors for a period of 13 years or more accumulate roughly 3 times more financial assets than non-advised investors over the same period. Interestingly, though, the study is clear that this higher accumulation of assets is not due to advisor skill, but rather due to the advisor encouraging good savings discipline with the investor. We note that while the study speaks of the value of advice, it doesn't define what is advice. Advice remains something that is to be defined only through the eyes of the beholder. Furthermore, the study establishes no causality between the payment of embedded commissions and the accumulation of assets. And finally, we note that the study suffers from survivorship bias in that only those advisor-client relationships that survive for the entire period examined were considered in the study. Those relationships that may have been terminated prior to that time, for instance, where the client fired their advisor, were not considered in the study. The industry has also pointed to the experience of other jurisdictions that have done away with embedded commissions, particularly in the UK, and suggested that whatever happened there would also likely happen here. We repeatedly heard that the UK experienced a significant advice gap, whereas the UK regulators' own reports don't seem to support this claim. In our view, the evidence the industry has provided to date is lacking and is insufficient at this time to dissuade us from further considering the option of discontinuing embedded commissions. So this brings us to our consultation objectives under Consultation Paper 81408. That paper was published on January 10th for a 150-day comment period ending June 9th of this year. We recognize that discontinuing embedded commissions could have a profound effect on the fund industry and on investors in Canada, including potential unintended consequences. We are mindful of the need to carefully assess the potential impacts of such a change before we make a policy decision. This includes the need to assess the potential for an advice gap developing in our market. We want to ensure that whatever decision we make will be a well-informed one that is founded on an analysis of facts about our market, including facts about our mutual fund investors, our dealers and representatives, and our investment fund managers. So our objectives with this second consultation on fund fees are specifically to assess the potential effects of discontinuing embedded commissions on investors and market participants. So in essence, our goal is to test the industry's assertion that this change would lead to an advice gap for certain Canadian investors. And we also want to examine the impact of this change on business models and market structure, including on the competitive landscape of the Canadian fund industry. Secondly, in the event we might decide to move forward with a proposal to discontinue embedded commissions, we want to hear about potential measures that could assist in mitigating the negative impacts of such a change on both investors and market participants. And third, to the extent you believe there are other options that we should be considering that you think could just as effectively address our concerns, we invite you to share your ideas with us. Overall, and I can't stress this enough, we want to hear something new. We don't want assertions or blanket statements that are unsupported by evidence or a sound rationale. For example, we've repeatedly heard that if embedded commissions are discontinued, dealers and their representatives will have to abandon their small clients or charge them more for the advice and services they provide, and that this will necessarily lead to an advice gap for smaller investors. But no one has yet provided a sound rationale for these increased costs or justified the quantum of those costs. If dealers and their representatives are able to service smaller investors now under the embedded commission model, why would that change under direct pay arrangements? Why would smaller investors need to pay more for the same services they're getting now? We've heard that under the current embedded compensation model, the fees that dealers and their representatives earn from higher net worth investors cross-subsidize the cost of providing services to less wealthy investors. If that's the case, does this mean that higher net worth investors are currently paying too much under the current embedded compensation model and smaller investors aren't paying enough? Would a move to a direct pay model eliminate this cross-subsidization, which seems to enable the provision of services to less wealthy investors? Questions like that and many others need to be answered so that we may gain a better understanding of the potential impacts of moving to a direct pay model. In addition, while there are certainly insights to be gained from the experience of other jurisdictions that have also discontinued embedded commissions, we can't just assume that our experience would be identical to theirs. Every market is different, the players in those markets are different, the competitive dynamics are different, and these differences can all play a role in shaping the specific impacts. With that in mind, we encourage those submitting comments to not simply point to the experience of other jurisdictions as proof of what would necessarily happen here. Arguments made should have some grounding in fact, and preferably Canadian facts. we think Consultation Paper 81408 sufficiently responds to the fund industry's call for evidence-based policymaking. And if you've read the paper, you'll have noted the substantial amount of data and evidence that we present, in particular in Part 4 and Appendix A of the paper, to support our analysis. And we request that your submissions on the paper be equally evidence-based to the extent possible. Moving now to an overview of the paper, I'll take you through Parts 2 and 3 of the paper, in which we set out the key investor protection and market efficiency issues related to embedded commissions and describe the scope of the potential policy if we were to move ahead with a proposal to discontinue embedded commissions. And after that, I'll leave it to Andrew to take you through the rest of the paper and advise you of next steps on this project. So in Part 2, we describe the specific issues that we've identified in connection with embedded commissions. And in Appendix A, we provide evidentiary support for each of those issues and their related harms. You'll note that we've assembled a body of research that goes far beyond the Professor Cumming and Bronsbury research that we commissioned in 2015. Appendix A consists of 30 pages of compelling research. And if you read through it, you'll see that the findings from the Cumming and Bronsbury research are not unique, but rather are quite in line with the findings from a number of other studies conducted by researchers and academics over the past decade that have examined the effects of embedded commissions on investor outcomes and market efficiency. So the first issue we discuss in Part 2 is the issue that embedded commissions raise conflicts of interest that misalign the interests of investment fund managers, dealers, and their representatives with those of investors. Based on the evidence we've gathered and reviewed, we find that the current embedded commission model aligns the investment fund manager's asset gathering and preservation objectives with the dealer's revenue maximization objectives. We find that this alignment of commercial interests can alter the behavior of investment fund managers and of the dealers and representatives who distribute investment fund products in a way that is detrimental to market efficiency and investor outcomes. Specifically, embedded commissions can cause investment fund managers to rely more on payments they make to dealers than on the generation of performance to attract and preserve assets under management. This can diminish the investment fund manager's focus on risk-adjusted outperformance, which can impact investor returns. The findings from the Professor Cumming research appear to confirm this to be the case. And secondly, embedded commissions can incent dealers and their representatives to make biased investment recommendations that give priority to maximizing compensation over the interests of the client. And many studies we cite in Appendix A find that biased advice has an economically significant impact on investor outcomes. And third, our research suggests that competition between investment fund managers to offer high embedded commissions to attract and secure distribution encourages and preserves high overall fund fees and discourages the manufacturing and sale of lower-cost alternatives, which limits price competition in Canada. This competition on the basis of commissions has a distorting effect on the allocation of capital because it may cause some investment fund managers to attract and retain more assets than is warranted on the basis of their performance, while others may attract less capital than is warranted, and it may discourage others from entering the market entirely. And on this point, in Appendix A of our paper, we provide data showing the limited availability of low-cost funds in Canada, including low-cost passively managed index funds. As you may know, passively managed index funds have lower management fees and pay lower trailing commissions to dealers relative to the commissions payable on actively managed funds. The trailing commissions on index funds usually sit between 10 and 25 basis points, which is substantially lower than the more typical 1% trailing commission paid on actively managed equity funds. Our data shows that low-cost passively managed mutual funds, excluding ETFs in Canada, make up only 1.5% of mutual fund total assets under management, and this number has remained essentially unchanged over the last 10 years, while the remaining 98.5% of mutual fund assets is actively managed. The low availability and low sales of passively managed index funds persists in Canada, despite the volume of research finding that most actively managed funds generally tend to not perform sufficiently well to justify their higher fees and tend to underperform their passive counterparts over time on a net of fees basis. In addition to this, we observe that lower-cost investment fund managers that sell their funds directly to clients rather than through third-party distributors, and which consequently do not pay trailing commissions, make up only 2.8% of assets under management in Canada, with no observable increase in market share over the last several years. These investment fund managers must rely strictly on the performance and attributes of their product to attract sales rather than the payment of compensation to dealers. And finally, we've heard from at least one well-known low-cost fund provider in the U.S. that the requirement to pay trailing commissions to compete in the Canadian market essentially acts as a barrier to entry, and this inhibits effective price competition in our market. The second issue we discuss in Part 2 is the issue that embedded commissions limit investor awareness, understanding, and control of dealer compensation costs. Specifically, due to their product-embedded nature, embedded commissions lack saliency, which limits investors' awareness of such fees. Our research is clear that the majority of Canadian fund investors are not aware of what they pay for financial advice, or that they pay for financial advice at all, which means that costs don't figure into their decision-making. Research also shows that investors are more sensitive to salient upfront fees like front-end loads, and are more likely to control visible and salient fees that they must pay directly. Secondly, embedded commissions add complexity to fund fees, which can inhibit investor understanding of costs. We find that embedded commissions have encouraged a proliferation of fund series, each denoted by a different letter of the alphabet, with the main difference between the series being the rate of the commission payable to the dealer. In addition to embedded commissions varying between series, they also typically vary by fund type, and also vary depending on the purchase option under which the investment's made. This level of complexity in the fund fee structure can make it very challenging for all but the more sophisticated investors to know the costs they're paying and assess their impact on their investment returns. Some of our research suggests that financial product providers may in fact strategically use price complexity to limit awareness of fees and maintain ignorance about prices. This in turn can increase investors' reliance on advisors for their investment choices and decisions, and in turn limit their control of costs. And this leads me to my last point on this issue, which is that embedded commissions, due to their product-embedded nature, restrict an investor's ability to directly control dealer compensation costs and their effect on investment outcomes. We note that Canadian retail investors have little choice but to bear the cost of trailing commissions. Even DIY investors who purchase mutual funds through discount brokerages are often made to bear the same trailing commissions that are paid to full-service dealers, even though DIY investors do not want and do not receive the same level of service as that provided by full-service dealers. And although the majority of investment fund managers today offer a fee-for-service fund series, typically denoted as Series F, under which investors may pay directly for their dealer's advice and services, a dealer's offering of this option to investors is usually contingent on the investor meeting a high fee-based account minimum, which makes these accounts inaccessible to most retail investors. The third and last issue we discuss in Part 2 is the issue that embedded commissions paid generally don't seem to align with the services provided to investors. Specifically, investors may not receive ongoing advice commensurate with the ongoing trailing commissions paid. Embedded commissions are paid to dealers regardless of the extent of the services that a representative provides to the investor in connection with an investment in a fund. The same compensation is paid irrespective of whether the dealer provides only transaction-oriented services or provides a broader range of ongoing investment advice tailored to the investor's specific needs. A case in point is, as I mentioned earlier, the matter of discount brokers who provide execution-only services but may receive the same ongoing trailing commission that would be paid to a full-service dealer. Similarly, it's often the case that funds of funds, which are prepackaged investment solutions that relieve the representative from having to do much of the fund selection and asset allocation they might otherwise have to do for a client, often pay higher than average trailing commissions. In our view, the absence of a clear relationship between the rate of the embedded commission paid to the dealer and their representative and the level of services an investor receives in return suggests that the payment of embedded commissions is tied to the simple distribution of the fund product as opposed to the provision of ongoing advice and services. If investors are getting basic one-time services centered on the trade as opposed to ongoing advice and services in exchange for the ongoing embedded commissions paid out of their fund's management fees, they may be indirectly paying too much for the services they're actually receiving. And this brings me to the last point I want to make about this issue, which is that the cost of advice provided through embedded commissions may exceed its benefit to investors. Some of the research we reviewed suggests that investors may derive no measurable net financial benefit from advice paid for through embedded commissions, and may in some cases be worse off because of it. Specifically, some research shows that investors receiving conflicted advice through the payment of embedded commissions tend to perform worse than non-advised investors or passive benchmarks. And dealers collect more in fees and commissions than any monetary value their investment advice may add to the account. Other research suggests that the benefits investors derive from advisors' advice may be largely behavioral and therefore intangible in nature, such as the development of good savings discipline, overcoming inertia, the reduction of anxiety, and the creation of trust. And all this brings into question whether investors are getting value for the money. To the extent they're not, this impacts their investment outcomes. In Part 3 of the paper, we discuss what a proposal to discontinue embedded commissions might look like if the CSA decided to move forward with rulemaking. So this is where we describe what types of securities would potentially be affected and what types of payments would potentially be discontinued if we moved ahead. The first thing I want to stress is that our proposal is not about whether advisors should get paid for the services they provide, nor is it about how much they get paid. Rather, it's simply about how they get paid, or more specifically, who pays them. Turning first to the types of securities that could potentially be affected by a rule discontinuing embedded commissions, we anticipate that this could include all investment funds, as well as structured notes, in each case whether offered to the public by prospectus or in the exempt market. In applying the rule to all investment funds, the proposal will capture all those funds that meet the definition of investment fund under securities regulation. So this would include conventional retail mutual funds, exchange-traded funds, closed-end funds, and pooled funds. And as for why we would include structured notes in the proposal, this is because concerns related to embedded commissions are obviously not unique to investment funds. All types of collective money management schemes that pay embedded commissions raise the same investor protection and market efficiency concerns, and structured notes are no exception, as they bear similarities to investment funds and commonly pay embedded commissions. Capturing structured notes in the scope of the regulation would promote a level playing field amongst comparable investment products and reduce opportunities for regulatory arbitrage. And the same goes for why the rule would cover investment fund products sold in the exempt market, again to create a level playing field and reduce opportunity for regulatory arbitrage. Given the findings from our research showing how embedded commissions reduce market efficiency and cause investor harm, it just would not make sense to allow embedded commissions in one context, but not in another. And what about insurance products, such as segregated funds? Won't they present an opportunity for regulatory arbitrage? Well, the risk is certainly there, but I point out that the insurance regulators are certainly attuned to this risk and have indicated that they will act proactively to amend regulation if necessary to address regulatory arbitrage between seg funds and mutual funds. I would point out that currently, seg funds make up a relatively small part of the investment fund landscape in terms of assets under management. Canadians currently hold $1.2 trillion in mutual fund assets versus only $110 billion in seg funds. The proportion of assets invested in mutual funds versus those invested in seg funds has remained relatively steady over the last 10 years, with mutual funds always being the dominant investment out of the two. That being the case, I think a sudden shift in assets from mutual funds to seg funds following a proposal to discontinue embedded commissions on mutual funds would be noticeable and would prompt securities and insurance regulators to take the necessary action to address regulatory arbitrage. As for the specific types of payments that would be discontinued, we anticipate that this would include any payment of money to dealers in connection with an investor's purchase or continued ownership of an investment fund security or structured note that is made directly or indirectly by any party other than the investor. At a minimum, this would do away with all trailing commissions and any upfront sales commissions that investment fund managers pay to dealers for purchases made under the deferred sales charge option. Dealers would have to obtain their compensation directly from investors, pursuant to direct pay arrangements under which investors would have the ability to negotiate and would explicitly agree to the specified method and rate of the dealer's compensation. We've repeatedly heard from industry that discontinuing embedded commissions would take away choice for investors and would force all investors to be in a fee-based arrangement where they're made to pay a percentage fee based on their assets under administration. In response to that, we want to be clear that direct pay arrangements would not require the use of fee-based arrangements in all cases, as we recognize that these types of arrangements may not be appropriate for all investors. We would expect clients to be given a choice of compensation arrangement that is suitable for their particular needs and objectives. This could involve an upfront transaction-based commission, an hourly fee, a flat fee, or an asset-based fee, or whatever other compensation arrangement a dealer might wish to offer their clients. Whatever the arrangement might be, the key is that under direct pay arrangements, the dealer would no longer be compensated by the investment fund manager and would have to be paid exclusively by the investors they serve. We've also heard from industry that investors won't be willing to pay directly for advice, as this would require them to come up with cash or write a check to pay for their advisor services, and that this inconvenience might cause some investors to forego advice. With that in mind, our proposal contemplates allowing investment fund managers to facilitate the investor's payment of their dealer's compensation by effecting periodic redemptions from that investor's account and remitting those amounts to the dealer on behalf of the investor. You may know that there are fee-based mutual fund series that operate this way already. They essentially function in the same way that a regular trailing commission-paying fund series operates, and that in both cases, the investment fund manager bears the burden of collecting and paying the dealer's compensation. What's different, however, is that the investor has the ability to negotiate and agree upfront to the rate of their dealer's compensation, and that the compensation is paid directly from the investor's account. We believe this option would go a long way to address concerns about investors' willingness to pay directly. Now, the last thing I want to point out is that we propose in Part 3 that certain types of payments from investment fund managers to dealers be excepted from any proposal to discontinue embedded commissions. This includes the payment of referral fees, dealer commissions paid out of underwriting commissions for an initial public offering, payments by investment fund managers for marketing and educational practices, and certain internal transfer payments from affiliates to dealers within integrated financial service providers. We recognize that these other types of payments similarly give rise to conflicts of interest that may continue to incent registrant behavior that may not favor investor interests. And so we're very interested in getting your feedback on whether these other payments should similarly be caught by a proposal to discontinue embedded commissions. At this point, I'll pass it off to Andrew, who will take you through the remainder of the paper and discuss next steps with you.
So thank you, Chantal. Now, as Chantal mentioned, I'm going to walk you through the remainder of the paper, which will cover our regulatory impact assessment, mitigation and transition measures, and current and related CSA initiatives that may also help address the issues we've identified and that Chantal has just discussed. But beginning with Part 4, the goal of this part is really to provide our assessment of the potential market impacts that may occur if we were to move forward with discontinuing embedded commissions, and also to explain the reasoning underpinning our views. Specifically, in Part 4, we lay out our assessment of the impacts a discontinuation may have on the Canadian investment fund sector, including on market structures, business models, and on the accessibility and scope of advice provided to all retail investors. Now, as a starting point of our analysis, and really what sets the foundation of our assessment, is a detailed examination of the overall landscape of the fund market as it exists today. We therefore begin Part 4 by laying out what we believe are important facts about the Canadian fund market and investors. Specifically, we examine a wealth of data compiled on Canadian households in various wealth bands, including the extent to which they use advice, the extent to which they hold investment funds, and the type of distributor from which they purchased. We also examine fund distribution in the MFDA and IIROC channels, as well as investment fund managers, and in each case, the extent to which they are independent or integrated. This analysis is based on data compiled from Investor Economics, IIROC, MFDA, Morningstar Direct, and the Ipsos Canadian Financial Monitor Survey, and where possible, we've used the most current data. So what does the data tell us, and what do we know about the investment fund market in Canadian households today? So, starting from the top, at the end of 2015, financial wealth of all Canadian households was approximately $3.8 trillion. Of this, approximately 40% of Canadians' wealth was invested in investment funds, being approximately $1.5 trillion. Now, despite the large dollar figure of investment fund ownership, when we look at individual households, we see that the majority of Canadians do not actually own investment funds, and in particular, only approximately 37% of Canadian households hold investment funds. Now, when we break down that 37% even further to see exactly what types of households hold these funds, we find a much lower use of investment funds by lower wealth investors, those being households with investable assets below $100,000. For example, of the Canadian households that actually do own investment funds, 39% have below $100,000 in investable assets. Now, for some added perspective, it's interesting to note that this group of households makes up the majority of all Canadian households, being approximately 67%. Now, despite that the vast majority of Canadians fall into this category, only 14.6% of these households relative to all Canadian households actually hold investment funds, so it's a very small proportion. And when these households do buy investment funds, where do they buy them from? Well, the data shows that an overwhelming majority, being approximately 88%, purchase from a bank or insurer-owned dealer. So to sum up, we find that very few households with investable assets below $100,000 actually buy investment funds, and when they do, the majority buy from banks or insurers. So why am I focusing on households with less than $100,000 in investable assets? Because this is the group of households that proponents of embedded commissions fear will fall into an advice gap if we ban embedded commissions. As I will return to and explain further later in the presentation, we believe these statistics help explain why an advice gap is not likely to develop in our market. Now, turning to investment fund distribution, we find that fund distributors owned by banks and insurers dominate investment fund distribution. For example, 87% of investment fund owning households purchased investment funds through a bank or insurer. And looked at another way, bank and insurer-owned dealers administered 81% of the assets, and that's in the MFDA and IIROC channels combined. We also see that banks and insurers tend to dominate investment fund management as well, as they manage 63% of the assets in Canada. And finally, we note a high level of vertical integration in Canada among both dealers and IFMs. In particular, we note that while integrated dealer firms only make up 48% of the firms in the MFDA and IIROC channels combined, they actually administer 95% of the assets in those channels. We also see that while integrated IFMs make up 42% of the firms, they manage 78% of mutual fund assets. So again, a very high level of vertical integration. So what does the data tell us? Well, when we look at the data, together with the application of basic economic theories, we believe that banning embedded commissions could have the following effects on the Canadian fund market. First, we anticipate that the number of fund series available in Canada would significantly decline as a result of a ban. This effect is expected because the vast majority of fund series available in the market today differ only by the level and type of embedded compensation paid to the dealer. So to put it quite simply, many of the series today would lose their reason for being. Now, based on figures from Morningstar, we estimate that the total number of series could fall by as much as 65%. This would significantly simplify fund fee structures, which are currently very complex and difficult to understand. So second, we also anticipate new lower-cost providers to enter the market, as new entrants wouldn't have to compete for shelf space on the basis of dealer compensation. In effect, a ban on embedded commissions could remove a significant barrier to entry. We also anticipate that these new product providers would enter the market with a wide range of passively and actively managed products. Third, we also expect to see increased competition and price pressure on asset management costs. And we expect this to occur for two main reasons. One reason is that the entrance of lower-cost providers will increase competition and likely exert downward pricing pressure on existing incumbents. Another reason is that, with the incentive to recommend funds based on embedded commissions out of the equation, over time, representatives may focus more on recommending lower-cost or passively managed products, as well as better-performing products. This in turn should put pressure on investment fund managers to lower costs and focus on performance. Fourth, we also expect to see a shift in assets across existing investment fund managers. For example, as representatives begin to recommend lower-cost products, we expect IFMs to respond by shifting to lower-cost and passively managed products. Also, high-performing investment fund managers that currently pay no or low trailing commissions may, if embedded commissions are discontinued, attract more assets than they currently do. This is because active investment fund managers would be left to compete on their performance alone rather than on payments made to dealers. Now, fifth, in the absence of embedded commissions, we would also expect to see existing and new market innovations. In particular, we could see further growth in robo-advice that could fill the potential need for less costly and simpler forms of advice. Now, finally, contrary to some assertions, we believe that a significant advice gap for lower wealth investors is unlikely, and there are a few reasons for this. One is, as discussed earlier, we find that households who are most at risk of falling into an advice gap, those with investable assets below $100,000, do not today buy investment funds. You will recall that only approximately 14% of these households, relative to all households in Canada, hold investment funds today. And when those households do, an overwhelming majority, approximately 88%, buy from banks or insurers. Now, we anticipate that the bank and insurer-owned dealers, whose business models aren't as reliant on embedded commissions, would likely continue to service these households with little to invest post any ban on embedded commissions. We also believe that, based on current market developments and increased product innovation in the robo-advisor space, they may have more access to cheaper forms of advice than they currently do. So this briefly sums up our assessment of the impacts discontinuing embedded commissions may have on the Canadian landscape. But before turning to the next session, I would like to stress that these are our views based on the data we have collected and our application of economic theories. We are keenly interested in hearing from stakeholders as to whether they agree with our assessment or not, and the reasons why. I also want to point out that we have included a number of consultation questions in the paper pertaining to our regulatory impact assessment to help engage in meaningful discussion, and we really do encourage stakeholders to comment on this part of the paper. I will turn now to Part 5 of the paper, which discusses mitigation measures and potential transition options. First off, we truly appreciate that a potential transition to direct pay arrangements would be a significant change for market participants that would take considerable time to implement. We are also aware that a shift toward direct pay arrangements could bring with it some potentially negative unintended consequences. As a result, to the extent we decide to move forward with a ban, our goal would be to proactively identify and incorporate various measures that could help alleviate any negative impacts and facilitate a successful transition. For example, we understand that there may be a reduction in access to advice for lower wealth investors. This may be due to the substantial changes to dealer business models and the cost that may be incurred in servicing these accounts. We anticipate that some of these impacts could be alleviated, at least to some extent, by innovations in technology, including various forms of online advice, which could be used by dealers to automate part of the advice process. Integrating this type of technology into business models could potentially add new capabilities and deliver efficiencies that could make the provision of advisory services to smaller accounts more viable. We also recognize that the requirement for an investor to pay directly for services may affect the behavior of certain investors in a way that may reduce their use of advice. Specifically, some investors may consider direct payments less convenient relative to the current model, which may deter them from seeking advice. To help alleviate this concern, we are proposing to allow investors to pay for their representatives' compensation through deductions from their purchase amounts or redemptions from their investment fund holdings, effectively allowing IFMs to facilitate the payment process for an investor. Now, as for the potential issue of low financial literacy hindering an investor's ability to assess the value of advisory services, or even to negotiate fair fees for those services, we anticipate continuing to work on investor literacy initiatives to increase awareness of investing costs and to empower investors to confidently engage in the negotiation of fees with their representative. Now, in the event the CSA moves forward with the ban, again, our goal would be to design transition measures that would mitigate any negative business and client impacts. We put forth 2 transition proposals in our paper, but we are also open to others that may be suggested by commentators, and we certainly encourage feedback on this part of the paper. Now, one potential transition option put forth would be to discontinue all embedded commission payments within a certain time period after the effective date of a final rule implementing a transition. Under this option, existing redemption schedules set by DSC purchase options could either be maintained after the transition date or discontinued at the same time with all other forms of embedded commissions such as trailing fees. Now, we are very mindful of the time and effort it will take the industry to transition, so in our view, it will be imperative to provide sufficient time to all parties to successfully transition. In this regard, we have suggested, at least as a starting point, a 3-year transition period. We are, however, open to other periods, and we do encourage stakeholders to specifically comment on this point. An alternate option to transition could also be to transition in phases, by phasing in a dealer's account base over multiple periods. This approach would require dealers to transition to a certain percentage of accounts by a certain date, a further percentage by a later date, and so on and so forth until all accounts are fully transitioned. Like the first option, we again propose a 3-year transition period. But I do want to stress again that we have not yet decided on any particular transition method or period, and we really do welcome feedback from stakeholders on each of the measures and periods, as well as any alternative options. Now, turning to the next part of the paper. Over the course of preparing the paper, we heard from industry that fee reforms were unnecessary in the wake of current and related CSA projects, or at the very least, we should wait and assess the impact of these projects to see the extent to which they address the issues we identified. Now, by way of background, the 3 main initiatives and tools we have to help address the identified issues are the point of sale and CRM initiatives, the proposals under Consultation Paper 33404, which is also known as the Best Interest Paper, and certain compliance review initiatives. I'm just going to very briefly discuss each of these initiatives and why we don't think they're going to go far enough. Now, as for point of sale and CRM, as many of you know, the point of sale reforms introduced the Fund Facts document that has replaced the lengthier prospectus. Importantly, this document highlights all applicable fees, including DSC charges and trailing commissions. The CRM reforms, which have been implemented in phases over the last several years, have been aimed at enhancing disclosure at account opening and in the performance reporting process. A particular objective of CRM was to increase investors' awareness of trailing commissions paid to dealers. Now, earlier this year, the CSA published Consultation Paper 33404, seeking comment on proposed regulatory action aimed at enhancing the obligations and duties of advisors, dealers, and representatives towards their clients. Broadly speaking, the concept proposals outlined in CP 33404 introduce a number of targeted reforms to National Instrument 31103. These include, among others, proposals to strengthen the regulation of conflicts of interest, the KYC and KYP requirements, the suitability obligations, proficiency of representatives, and the use of titles. In addition to these targeted reforms, all of the CSA jurisdictions except BC are proposing a best interest standard, which would require that a dealer deal fairly, honestly, and in good faith with its clients and act in its clients' best interests. Finally, the CSA can also use compliance review initiatives. In this regard, some CSA members are completing various compliance review initiatives on sales incentives that may give rise to a conflict of interest. For example, the OSC completed a focused review of mutual fund-sponsored conferences organized and presented by investment fund managers to assess their compliance with National Instrument 81105. So, what do we think these reforms will do? Well, taken together, and very generally, the increased disclosure of fees and performance should really lead to increased transparency and allow investors to better assess the value of the services provided by their advisors. The enhanced conflict of interest mitigation proposals, along with the enhancements to KYP, KYC, and suitability, may also reduce the role that tied compensation plays in the fund selection process. This in turn may lead advisors to recommend more suitable, lower-cost products and potentially even better-performing products. We would also hope that IFMs would respond to these shifts by producing lower-cost funds and focusing more on performance. So while these reforms may help address some of the issues we've identified, including the conflict of interest inherent in an embedded compensation model, we still don't think they're going to go far enough. And quite simply, we don't think they're going to go far enough because embedded commissions will still be permitted. As a result, the compensation bias inherent in the fee structure will likely continue to incent dealers to recommend products that give priority to maximizing their revenue over their clients' interests. Also, we are of the view that until dealer recommendations shift to the degree necessary to trigger change at the IFM level, if this happens at all, IFMs may rely more on compensation paid to dealers than skill to sell their products and gain market share. Compounding this problem is that trailing commissions will act as a barrier to entry and reduce the possibility for new, lower-cost providers from entering the market. Similarly, even existing high-performing fund managers that currently do not pay trailing commissions, or very low trailing commissions, will be at a disadvantage to IFMs that do, reducing overall competition in the marketplace. Moreover, with embedded commissions in the picture, the fee structure will continue to remain complex, which, as we've discussed, tends to reduce an investor's awareness, understanding, and control of dealer compensation costs. So that sums up our view on how these reforms will address the issues we identified, but I just want to briefly touch on the appendices of the paper and next steps. As for the rest of the paper, we've included a variety of appendices that discuss in detail the evidence of harm to investor protection and market efficiency from embedded commissions. We also generally discuss some of the other options we consider to address the issues identified, but have chosen not to consider further. We've also included an overview of current regulatory reforms on mutual fund fees in other jurisdictions, including in the US and UK. And finally, we have included a summary of all consultation questions. In terms of next steps, we will be considering all comments received through the comment process. As a reminder, the comment period will close on June 9th. Some jurisdictions will be holding local consultations either during or following the comment period. Speaking for the OSC, we plan to hold a roundtable in late summer or early fall to facilitate additional feedback. We will then consider all of the feedback received and aim to make a policy decision by the end of the year or early next. Well, this concludes this part of the presentation, and we'd now like to open it up to you for questions.